Hey guys, today I'm going to be introducing you to margin trading, a method that's going to be able to help you double your profits if done correctly. But this is also one of the most risky methods of investing, which can also cause you to lose double your money at the same time. Let me stress this. This can only be used by people that know what they're doing. Use this as an advanced trader. Know which stocks you're buying and know what you're investing in, because if you invest in the wrong assets, you're going to lose a lot of money. Margin trading is basically that you lend money to invest into the stock market. So let's give a simple case. Let's say you invest $2,000. This means you can lend an additional $2,000, so your total investment value is $4,000. And that $2,000 that you lent is what's called margin. So let's take an example of what that would mean for your investments if you would be trading on margin and how that would affect your return. So let's bring back that example of $4,000 and you invested that and that went up by 10%. Now your total value of your investment is $4,400. So what was the return on your investment? Well, simply, you invested $2,000 and the total value of the investment went up by $400. That means your return is the $400 on the $2,000, which is a 20% return, which is basically double the 10% of what you invested in, which is quite a good return. But now that it can go up by 10% and increasing your value by 20%, it can also go down the other way. And that's where the biggest risk is with margin trading. So now let's jump right back to the example, $4,000. And let's say the stock market goes down by 10%. That means that your investment value now went down from $4,000 to $3,600. Now you would say that you lost 10%, but in actual terms, because you went down $400, you still owe the $2,000 that you have on margin. That is an owed amount. That's not going to disappear. So the value that went down for you is $2,000 minus the $400, which is $1,600. So that means you just lost 20% of your investment. Now, if you would hold on to these stocks and you would keep them, in most cases, they would go back up and rise again if you pick the right stocks. But there's a catch with margin trading, which can cause it to be very costly. And that's what's called a margin call. It's one of the scariest things out there in the financial world. So let me explain what it is. When you're buying on margin, you need to have certain collateral of your own equities in the total investment portfolio. And this is what's called the maintenance margin. So this collateral is a minimum of 25% of the investment value. So let's take back that example and it goes down by 10%. What is your collateral there? So your total investment now is $1,600 because it went down by 10% and the total investment value is $3,600. So the collateral that you have is $1,600 divided by 3,600 total investment value, which is 44%. That is well above the maintenance margin that you need to have of 25%. But now let's say the market drops by 40%. That means the total value of investment drops by $1,600, bringing it to a total value of $2,400. Now, you only own $400 of this $2,400 and still owe $2,000. So when you divide 400 divided by 2,400, the collateral you have is 16.66%, which is below the 25% margin threshold. Now it becomes very interesting and scary because you have between 24 hours to 72 hours, depending on your brokerage, to make sure you get back to that 25% collateral. And if you do not, the stocks will automatically be sold for you until you meet the 25% collateral. And this means you're going to lose a lot if you're forced to sell at its low. And sometimes this can lead to serious losses. Just for example, a case with ABN-AMRO, a Dutch bank, they lost $200 million because of one margin call. So now that you understand the benefits of margin trading and the risks of margin trading, how do you best implement margin trading for yourself if you want to get started? The first rule of thumb is to have a considerable cushion of safety for if a market downturn happens. So what I mean with this is simply don't lend the full amount of the margin. A good rule of thumb is that you lend 30% of the margin that you're allowed to trade on. So when the market drops, you don't immediately have to be in a danger zone. You can easily see where the market's going to go from it. Second thing is to take a look at the price to book value of the S&P 500. I'll put a link below of where you can find this. The price to book value is basically the price you pay for the assets the company has. As assets are more stable than earnings, I rather use this than the PE ratio, which I also explained in a different video. And I'll explain the price to book ratio in another video, as that is a whole subject by itself. So when I would want to use more margin is when the price to book value is actually below a certain threshold. When the price to book value is below 2.5, I would consider increasing my margin position to 40%. There's a little downside from here, as I've shown here in the graph. But as you can see now, the price to book value is above 3. This is what I consider quite high and is more risky to buy much on margin, as there is a lot of downside from here. When the price to book value is this high, I would not consider going above a 20% margin, unless you buy very stock specific and the stocks are extreme bargains. Guys, if you like this content, please subscribe to the channel, hit that like button, and comment below with anything that you would like to know more about or any questions that you might have. Thanks for watching. Until next time.